Welcome to Thoughts on the Market. I'm James Lord, Morgan Stanley's Head of Foreign Exchange and Emerging Market Strategy. Along with my colleagues bringing you a variety of perspectives, today I'll be discussing the status of the US dollar within global foreign exchange, or FX reserves. It's Friday, July 7th at 3 p.m. in London. The debate about the dollar's status as the world's dominant currency usually resurfaces during every business cycle. And as our world increasingly transitions from globalized toward a multipolar model, this debate appears more relevant. Indeed, some economic actors are already de-risking their currency reserves away from the dollar, promoting the use of local currencies as an alternative in international trade and trying to reduce the dollar's global role through other means. Yet this debate is usually a distraction from determining where the dollar is headed. In contrast to the popular narrative, we believe the dollar can appreciate even if its use as a reserve currency or invoicing currency in international trade declines. Let's first address the dollar's status as the world's dominant central bank reserve currency. The purpose of FX reserves is to bolster the external stability of an economy and enable central banks to act as lenders of last resort to those in demand of foreign currency. It's intuitive to think that FX reserve choices might therefore be correlated with the value of currencies themselves, yet relying on that intuition would not have served you well in recent history. Case in point, while the dollar remains the world's dominant reserve currency, its share has dropped by around 20% over the last 20 years, most rapidly over the last 10. Nevertheless, over the last decade, the dollar has been one of the world's strongest currencies, with the Fed's real broad dollar index reaching a near 20-year high in October 2022. The dollar's declining share of global FX reserves has not been relevant in figuring out where the dollar is heading, in part because FX reserve managers are less influential in currency markets today, but more importantly because other investors have favored US assets. To be clear, this does not mean that watching trends in FX reserves is not important. A sudden, sharp decline in the market share of a reserve currency could well be driven by a sudden loss of confidence in the macroeconomic stability of an economy, diminishing its attraction as an investment destination. If so, the currency of that economy would likely decline. This concern has not driven the decline of the dollar's share of global FX reserves in recent years, as evidenced by its continued strength. Moreover, US assets retain unique appeal for global capital as the recent boom in US tech stocks and rising optimism about the productivity-enhancing implications of AI show. Meanwhile, the dollar provides one of the highest yields of the world's major currencies thanks to the Fed's hiking cycle. In a world of weak global growth, this yield will also likely help the dollar to appreciate. For clues about the future direction of exchange rates, we would be watching for signs that investment opportunities in different economies are improving. For now, the dollar offers attractive yields and remains a safe harbor during the current period of slow global economic growth. Thanks for listening. If you enjoy the show, please leave us a review on Apple Podcasts and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.